Have you ever watched The Wolf of Wall Street and imagined investment bankers as a bunch of guys in suits, phones in hand, screaming, "Buy, buy, buy," in front of two flashing red and green screens like an internet cafe during peak hours? Sorry to disappoint you. That's Hollywood. The truth is, far more boring. But it's precisely because it's boring that it makes an absurd amount of money. In 2024, Goldman Sachs, one of the biggest investment banks on the planet, made over $53 billion in revenue. And here's the surprising part. Most of that money did not come from trading stocks. It came from things that sound extremely corporate, like advising on company mergers and managing money for wealthy people. Sounds sleepy already, doesn't it? And yet, that sleepy business is the real gold mine. Today, we're going to dissect exactly how that sleepy gold mine works. Guaranteed that by the end, you'll look at those suited bankers differently, with a bit more respect, and maybe a little envy too. The harsh truth: they barely gamble anymore. After the 2008 crisis, regulators in the United States got furious and passed a rule called the Volcker Rule, which essentially says banks are banned from taking their own money and betting it on the market like a casino. So today, when an investment bank trades, almost 100% of the time it is acting on behalf of a client, a pension fund, a corporation, an asset manager, not throwing its own cash all in like in the movies. So if it's not gambling, where does the money come from? There are four main money-printing engines. Sit tight, because each one has its own plot twist. Engine number 1. Merger and Acquisition Advisory, the billion-dollar matchmaking business. This is the most classic job of a banker. When Company A wants to acquire Company B, a bank is hired to value the deal, negotiate, and hold the client's hand through months of tense back and forth, like negotiating a divorce. Except in divorce, nobody pays you millions. Here's the interesting part. The fee isn't fixed. The smaller the deal, the higher the percentage fee, around 5% for deals under $10 million. But the bigger the deal, the smaller the percentage, dropping to 0.5%. Sounds like a loss, but do the math. 1% of $1 billion is $10 million, for a matter that takes a few months. Not bad for a job that mainly involves talking and signing paperwork. And here's the part that's both playing the game and calling the shots. If the buyer needs to borrow money to fund the deal, the same bank usually arranges that loan too, and earns a separate fee for it. One arrow, two birds. Once a bank has advised someone on one major deal, it's almost guaranteed to get the call for the next one. That's why you keep seeing the same handful of names on every mega deal in the world. Not because they hold a monopoly, but because trust is built one piece at a time, deal by deal, over decades. Engine number 2. Underwriting. When banks buy wholesale, sell retail. On stocks. When a company wants to go public for the first time, an IPO, or issue bonds to raise capital, most people assume the bank simply helps sell the shares. Not quite right. The truth is, the bank often buys outright the shares from the company at an agreed-upon price, then resells them to investors. If the resale goes well, the bank pockets the spread. If it doesn't sell, the bank is stuck holding the shares itself. This is real risk, with real money, not just advice on a slide deck. Because of that risk, banks typically charge around 3% of the amount raised for an IPO, and under 2% for bonds. Bonds are safer, so the fee is lower. Here's a concrete example. In June of 2026, SpaceX went public on the NASDAQ at $135 a share, raising around $75 billion, the largest IPO in history, valuing the company at roughly $1.75 trillion. And this wasn't done by a single bank alone. 10 banks shared the underwriting job, led by Goldman Sachs and Morgan Stanley. Engine number 3. Market making. A currency exchange booth but universe-sized. Don't assume investment banks sit around guessing, will the stock go up or down tomorrow, the way you watch the news and click buy. Most of their trading activity is called market making, and it works exactly like a currency exchange booth at the airport. The person behind that counter isn't predicting whether the dollar will rise tomorrow. They're simply always ready to buy or sell, and they profit from the small gap between the buying price and the selling price, repeated thousands of times a day. When a pension fund needs to sell $500 million of stock without crashing the price, they call a bank's trading desk to handle it smoothly. The bank profits from that small spread plus service fees, not from betting on market direction. Small margin, but the scale is massive. In 2024 alone, Goldman Sachs's combined trading and investment banking division brought in almost $35 billion. Engine number 4. Asset and Wealth Management, a subscription model for the rich. This is the least flashy of the four, but arguably the smartest, because it's recurring. When a bank manages money for wealthy individuals, pension funds, or institutions, it typically charges an annual fee of around 0.5 to 1% of total assets, regardless of whether the market goes up or down that year. Sounds like Netflix charging you monthly whether you watch anything or not, right? The key difference: M&A fees are one-time events. The deal closes, the bank gets paid, then has to go find the next deal. Wealth management fees, on the other hand, flow in year after year, like a stream that never runs dry. This division alone brought Goldman Sachs over $16 billion in 2024, managing assets that had grown to over $3 trillion. A number that will make your ears ring. One deal equals 1,200 years of salary. To make this concrete, imagine a company gets acquired for $10 billion. The advising bank might charge a fee of around 0.75%, a fairly typical rate for a deal this size. That comes out to $75 million for a single transaction, usually wrapped up within 6 to 12 months. The median annual salary in the United States is around $60,000. That single fee is equal to over 1,200 years of an average person's salary, earned by a team of only about 20 to 40 bankers. And that's often just one fee. If the bank also arranges the financing loan, then no need to even calculate. It's dizzying. This is why outsiders assume bankers are paid an outrageous amount just to do paperwork. But the real reason this industry generates such enormous sums is that almost no one else on earth can do this job. A moat no app can break. Why hasn't some fintech startup jumped in to disrupt this lucrative industry? Because 4 things protect it, sturdier than any fortress wall. 1. Relationships. A corporate CEO doesn't Google a random bank for a $10 billion deal. They call the banker who has worked alongside them and kept their secrets for 15 years. 2. Distribution. When a company needs to sell $2 billion of new stock, someone has to find buyers willing to write enormous checks, fast. Big banks already have networks of thousands of institutional investors. 3. Balance sheet. Remember the buy the shares outright, then resell part? That requires tens of billions of dollars in reserve capital to absorb the risk. 4. Trust. When a company is about to make the biggest financial decision in its history, it needs an advisor with a track record of confidentiality and reliability, not the cheapest bidder. That trust is built deal by deal, and a single leak or a botched IPO can destroy it overnight. Put all 4 together, and you get an industry that is nearly impenetrable to any clever app or lower fee. So stop confusing these 3 things. A lot of people mix up investment bank, hedge fund, and commercial bank as if they were the same thing. They are not. Commercial bank, the branch near your house, taking deposits, paying a little interest, and lending money out for mortgages and car loans. Think Bank of America or Chase in their retail role. Hedge fund, a private fund that takes money from wealthy individuals and institutions, then actively bets on the market to generate returns. This is closer to the gambling image most people imagine. Investment bank does not primarily do either of the above. It acts as the intermediary for deals, capital raising, trading, and managing money for institutional and wealthy clients. Some banks, like JPMorgan, combine both models under one roof, which adds to the confusion. But the underlying operations are entirely different businesses, with different risks. So next time you hear someone criticize reckless gambling banks, they're likely describing hedge fund behavior or pre-2008 trading habits, something that barely exists in that old form anymore. So next time you watch a movie showing a guy in a suit screaming into a phone on a trading floor awash in red, go ahead and enjoy it. That's entertainment. But the real, big, sustainable money in investment banking sits in quiet conference rooms, where people sign advisory contracts, manage funds, and build trust over decades. Turns out, the most boring thing is exactly the thing that makes the most durable money. That lesson probably isn't just true for banks. If you found this video helpful, don't forget to like and subscribe to help grow this community. Thank you so much for watching, and I'll see you in the next one.